Imagine you have a bucket you're trying to fill with water. Every day you add a gallon, hoping it eventually overflows. But there's a tiny, almost invisible hole at the bottom. At first, it's just a few drops, easy to ignore. You might not notice it for years. Over a lifetime, those drops add up. That's what an expense ratio does to your account. An expense ratio covers a fund's operating costs. Think of a fund as a business with employees, research, and administration. The largest share often pays portfolio managers who pick investments. It also covers marketing, legal, accounting, the day-to-day logistics. Every dollar spent is a dollar not returned to you. There are two broad types: active funds and passive index funds. Active funds try to beat the market, a hands-on, resource-heavy approach. Result: higher expense ratios, often 0.5% to over 1%. That 0.5 to 1% may not sound like much, but over 20 years, it can cost you tens of thousands of dollars. Passive funds replicate the market, requiring far less decision-making. Operating costs are lower. Some expense ratios are 0.03% or less. You save more of your money. Core difference: strategy and cost. Choosing low cost is a simple, powerful decision most investors can control. Expense ratios reveal their impact over decades, not a single year. When your money earns returns, those returns can earn returns. Fees interrupt that virtuous cycle. Lower net returns compound more slowly, widening the gap over time. You lose the fee and all the future growth it could have generated. Example: $10,000, hypothetical 7% before fees. Fund A, 0.10%. Fund B, 1.10%. A 1% difference. After 1 year, the gap is about $100 or small. After 30 years, about $74,172 versus $55,934, a $19,000 gap. The cost isn't linear, it grows exponentially with time. Early fees hurt most. The less you give away, the more you keep. Let's look at another example. Two friends start investing today. Both save $500 a month for 40 years in US stock funds. Assume the same 8% gross return. Sarah chooses a low-cost index fund at 0.04%. Tom picks an active fund at 1.04%. Early on, their balances look the same. The fee seems trivial, but net compounding differs: 7.96% versus 6.96%. Each year, the drag on Tom's portfolio grows heavier. At retirement, Sarah has about $1.73 million. Tom has about $1.29 million. Same savings, same market, an approximate $440,000 difference. It was eaten away, bit, by fees. Investing isn't impossibly complex. One high-impact action is simple: pay attention to fees. You can't control the market, but you can control costs. Audit your accounts. Find each fund's expense ratio. Write them down: 0.10%, 0.50%, over 1.0%. Know the number. For high-cost funds, there's usually a lower-cost alternative tracking the same benchmark. Make cost a primary filter when choosing funds. Evidence shows low-cost funds tend to do better over time because their hurdle is lower. Let compounding work for you, not against you. Favor simple, low-cost index funds for your core portfolio. Every dollar you save on fees stays in your bucket, compounding for your future. Enjoyed this? Please like and subscribe for more tips to make your money last.